In 2020, the United States created about $3 trillion out of thin air. Not mined, not taxed, not earned, just created. And the world didn't collapse. No wheelbarrows full of cash, no trillion-dollar loaf of bread. In fact, investors around the world rushed to buy more dollars. Now try the same experiment somewhere else. Zimbabwe prints money. Inflation explodes. The currency dies. Argentina prints money. Prices double. Savings evaporate. Turkey prints money. The currency sinks. So here's the uncomfortable question. Why can some countries create money like a video game cheat code, while others trigger economic disaster the moment they try? Because the truth is this: money printing isn't really about money, it's about power. And the global financial system has a very clear hierarchy. At the top are a few countries that can bend the rules. At the bottom are countries that pay the price when they try. And once you see how the system actually works, you start realizing the world economy is a lot less fair than it looks. Let's start with a simple idea. Every country prints money. All of them. The United States prints dollars, Japan prints yen, Europe prints euros, India prints rupees. Technically, it's done by central banks. When a government needs to spend more money than it collects in taxes, it borrows, usually by selling government bonds. Those bonds are bought by investors, but sometimes the central bank steps in. It creates new money digitally and buys those bonds itself. That process has a polite technical name: quantitative easing. But stripped of the jargon, it's simple. The government spends money, the central bank creates money, and the economy keeps moving. In theory, this should be dangerous. If money supply rises too fast, prices should explode. History gives us plenty of horror stories. Germany in the 1920s, Zimbabwe in the 2000s, Venezuela more recently. Currencies collapsing, savings destroyed, entire economies spiraling. So why didn't that happen when rich countries printed trillions? Why didn't the dollar collapse? Because the dollar isn't just a currency, it's the center of the global system. After World War II, the United States built a financial architecture that still shapes the world today. In 1944, world leaders met in a quiet town called Bretton Woods. The goal was simple: create a stable global economy after the chaos of war. The solution? Anchor everything to the US dollar. Other currencies would link themselves to the dollar, and the dollar itself was linked to gold. That system eventually ended in 1971 when the US stopped backing dollars with gold. But something strange happened. The dollar didn't collapse. Instead, it became even more powerful. Today, about 60% of global foreign exchange reserves are held in dollars. Most global trade, from oil to airplanes, is priced in dollars. International loans are often issued in dollars. Even countries that dislike the United States still depend on its currency, which means when the US prints money, the world absorbs it. Not just Americans, everyone. Imagine the global economy as a giant stadium. Most countries are players on the field, but a few countries control the scoreboard. When they create money, the demand for that money is global. Banks hold it, companies trade in it, governments store it as reserves. So when the US Federal Reserve prints trillions, the new dollars spread across the entire planet. The pressure is diluted. Inflation still happens, but it's manageable. Now compare that to a smaller or poorer country. Let's say Argentina. When Argentina prints money, who wants it? Mostly Argentinians, and many of them don't even want it. They convert savings into dollars. They move money abroad. They buy property instead of holding cash. So the demand for the local currency collapses, but the supply keeps rising. That's when inflation explodes. And once inflation starts, it becomes psychological. People rush to spend money before prices rise. Businesses raise prices faster. The currency loses credibility, and credibility, once lost, is brutally hard to rebuild. But there's an even deeper problem. Many developing countries borrow money in foreign currencies, especially dollars. That means their debts must be repaid in dollars, not their own money. So if their currency weakens, their debt burden grows instantly. Let's say a country owes $10 billion. If its currency falls by half, that debt effectively doubles. Now the government needs more and more local money just to buy dollars. And how does it get that money? By printing more, which weakens the currency further. It becomes a vicious cycle: inflation, currency crash, debt crisis. That's why printing money is so dangerous for many countries. They're not just managing their own economy. They're trapped inside a global system dominated by other currencies. And there's an even irony here. When rich countries print money, global investors often run towards them, not away. During the 2008 financial crisis, the US printed massive amounts of money. Global markets stabilized. During the pandemic, trillions more were created. Again,
the dollar remained dominant. But when emerging economies face smaller shocks, they're often forced to raise interest rates, cut spending, and accept painful recessions, not because their leaders are necessarily incompetent, but because the system gives them far less room to maneuver. Economists sometimes call this exorbitant privilege, the ability to borrow and print money without facing the same consequences. And only a few countries truly have it: the United States, the Eurozone, Japan, to some extent the UK. Everyone else operates under stricter limits. They must defend their currency, maintain investor confidence, avoid printing too much, or risk financial chaos, which leads to a strange global paradox. The countries with the most economic power can safely use money creation as a tool. The countries that might need it the most often can't, because the moment they try, markets panic, currencies fall, and the crisis begins. So when people say governments can just print money, the real answer is more complicated. Yes, they can, but only some governments can do it without consequences. And even for them, the limits aren't infinite. In the past few years, inflation finally returned to many rich economies. Central banks raised interest rates aggressively. Trillions of liquidity started draining from the system, which quietly reminded everyone of something important. Even the most powerful currencies depend on trust. Trust that the government will eventually control inflation. Trust that the economy remains productive. Trust that the system itself continues working, because money at its core isn't paper, it's belief, and belief is fragile. So the real question isn't just why rich countries can print money. The more interesting question is this: how long can the global system keep absorbing it before the rest of the world decides that it doesn't want to play by those rules anymore?